if you get an increase in trade fails, you're going to risk higher volatility in the bond markets. The move index moves up, repos spike, and more dealer banks go to the Fed's standing repo facility and try to get cash. And this is really the issue that we've got. Markets are in a slow motion car crash, and we've got to be watchful to see that the Fed does something. Now, what does it mean for risk assets like equities? This chart may give some insight into what's going on. The red line is our estimate of Fed liquidity. So this is the aggregate that we've created from the balance sheet. It's the liquidity generating elements of the balance sheet. This is how it's moved over time since the early 2000s. You can see really what's been going on. It was, difficult to see what was operating pre 2008, but I have to say that most of the driver of markets pre 2008 was private banks through excessive lending or whatever, leveraging. What it is now has really been central banks have been the main source of liquidity. And if you look at the gyrations in the red line, you can see that they broadly line up, certainly with big moves in the S&P, which is shown in orange. Now, the S&P here has been lagged by 25 weeks, okay, so almost half a year. And this is showing the broad alignment between Fed liquidity and the S&P. So if you join the dots here, what you've got to say is the S&P is vulnerable to some pullback based on the fact that the Fed is taking liquidity out.